The US non-farm payroll data released last week provided softer than expected results, as job gain was only half of that forecast. Despite this, some researchers claim that the US has hit its sweet spot in its recovery, whilst others suggest that historical trends show that the US is not out of the woods yet. Wading into the debate is Dr. Frank Hollenbeck. Dr. Frank, thank you very much for joining us. Now, if we take a look at this chart, we can see the average length for US recessions. Now, already the crash of 2007 has exceeded the average duration. Researchers are now arguing, are we in recovery from a financial crisis or simply the recession that historically precedes a crisis of this size? Talk us through this debate.
Well, the thing about this graph is that there are three problems. The first one is that it's focused on the United States and not recessions in other parts of the world. The second problem is that it doesn't distinguish between recessions due to financial crises and recessions due to other things. And the third problem we have with this is that the turnaround period is when we have an improvement in per capita GDP. Now, in general, when we look at recessions after financial crisis, they tend to be deep, they tend to be of long duration, and they tend to have a lot of volatility. There was a study done by Carmen Reinhardt and Kenneth Rogoff, who looked at recessions after financial crises, and they found that when you base it on per capita GDP returning to its pre-crisis level, it usually took about 4.5 years. And that was also the case for unemployment. And housing prices may have taken up to a decade before they returned to their pre-crisis levels. Another study done by Vincent Reinhardt and Kenneth Rogoff looked at 15 recessions after financial crisis. And they found that for 10 out of the 15 crises, it took almost a decade for unemployment to go back to its pre-crisis level. And they also found that in 7 out of the 15 recessions due to financial crisis, they found that they had a double dip in the sense that the economy improved and then went back down, just like we did during the Great Depression. So we have to distinguish between just recessions and recessions due to the financial crisis we had in 2008.
This financial crisis is often compared to the Great Depression as the only other crisis of this magnitude. But can we realistically apply these trends to this modern economic environment?
Well, the IMF came to the same conclusion when they looked at recessions after financial crisis, that they tend to be deep and long-lasting. If we want to take an example, we can look at Japan, who's been in a recession for over 20 years. And we can look at the Great Moderation crowd, who said that without government intervention, we would have had a depression. And now they're changing the goalposts. They're saying, well, the recession in 2008 was really severe, and therefore the rebound will be even stronger. Okay, that's unlikely to occur. But even if we did have a rebound, let's say that what's happening right now in the US is an improvement. Okay, what would we expect under an improvement? We would expect interest rates to increase. Okay, as banks start lending to businesses, okay, we would expect interest rates to increase. But as I indicated in my last interviews, if interest rates were to increase, then the debt situation in the US would become untenable. And if interest rates were to increase in Europe, the same thing would occur. So we would go from a deep recession to a little bit of an improvement to another financial crisis dealing with sovereign debt. So in other words, we've set up a situation where we can never get back to normal. Okay. Now we maybe can accept that in the United States, okay, and we maybe accepted that in Japan for 20 years, but I doubt if the Latin Europeans are going to accept, 20 years of recessions, especially when you have 50% unemployment among the young in Spain, 50% unemployment among the young in Portugal, the same thing in Greece. We saw what happened, the detonator that when we had the a retiree basically said he wanted to end his life honorably instead of having to scavenge for food in the garbage cans, and that's had a significant impact in Greece. We can expect another type of detonating event in Europe because we simply can't have year and years of situations where the young are employed to the level that we're seeing today.
We also have to question whether an economy is likely to reach its earlier trajectory of growth, or if some output will be lost forever. Are we already seeing examples of this in adjusted targets?
Well, the OECD did a study and showed that some of that output is lost forever, even though it's difficult to do such studies over a decade. My concern is that with the levels of unemployment we're seeing, we may see social upheaval, and that puts everything up on the table. We saw what happened in Germany in the 1930s. We saw what happened in other countries such as Spain, and I would hate for the situation to unravel as I expect it to unravel in the future. So that's a big concern of mine.
Dr. Frank, thank you very much. Dr. Frank Hollenbeck will be joining us again next week to sink his teeth into another financial topic. For now though, goodbye.